Okay, let's dive right into this. Welcome to today's explainer. We're going to unpack what might honestly be the most monumental, high-stakes corporate drama unfolding in the financial world right now. We're looking at Tata Sons. Now, if you follow global markets or Indian business, you definitely know the name. But right now, there's this massive looming situation regarding a potential IPO, an initial public offering, for this legendary powerhouse. And the craziest part of all this, it's a debut they are literally fighting tooth and nail to avoid. Let's look at why. Think about this for a second. India's most trusted business name has never sold a single share to the public. Never. We are talking about an unbroken historical record here. For generations, through huge economic shifts, global crises, massive expansions, the holding company at the very top of this entire empire has remained fiercely, uncompromisingly private. That privacy is just baked right into their DNA. It gives them the absolute freedom to think in decades instead of stressing over quarterly earnings reports. But that long-standing reality might be about to change, whether they like it or not. So, what happens when the Reserve Bank of India actually forces their hand? This is the core of our story today. It's one thing to decide to go public because, you want to raise capital or reward your shareholders. But it is a completely different beast when the central banking authority of your country essentially forces you to do it. This completely changes the entire dynamic. It goes from a strategic business decision to a super high-stakes compliance battle. Section 1. Demystifying the RBI ultimatum. The whole friction really comes down to this specific bit of regulatory jargon: upper layer NBFC. Now, NBFC stands for non-banking financial company. You can think of this classification kind of like a regulatory financial weight class. The RBI looks at the sheer size, the scale, and the systemic importance of certain financial entities, and if you're big enough, they bump you up into this upper layer category. And when you get put into this specific weight class, it triggers a cascade of strict scrutiny, and most importantly for our explainer today, a mandatory public listing. And Tata Sons is now caught right in this regulatory net. They were officially classified this way by the RBI, basically because they hold such massive assets and exert enormous financial influence. The regulators stepped in and said, look, you are just too big and too important to operate entirely in the private shadows. And you can see how this classification fundamentally clashes with their 150-year history of private ownership. It's this massive collision between the modern regulatory push for absolute transparency and one of the oldest, most tightly held corporate structures in the world. Section 2, the regulatory chess match. Now, Tata Sons isn't just taking this lying down. You really have to think of these dates as moves and countermoves on a giant board, because this is where the strategy gets super interesting. The opening move was back in the year 2022, when the RBI handed down that initial upper layer classification, while Tata Sons immediately went to work on their countermoves. In the present day, we're seeing them launch aggressive deregistration bids. They are actively trying to prove to the RBI that they shouldn't even be in this weight class anymore. One of the most fascinating tactics they've used? The massive TCS share sale. Tata Sons has literally been selling off stakes in their crown jewel, Tata Consultancy Services, just to pay down debt and restructure their balance sheet. It's all a highly calculated bid to restructure themselves right out of that upper layer NBFC definition. But here's the ultimate pressure point in all of this: 2026. This isn't just some open-ended debate. There is a hard, absolute deadline looming. Specifically, crucial rule changes and compliance deadlines are going to hit in April and June of 2026. If Tata Sons cannot successfully deregister by then, the clock runs out. A forced public listing becomes an unavoidable reality. So the pressure is immense, and that runway is getting shorter by the day. Section 3, Clash of the Titans. Because this isn't just a battle with a regulator, it is deeply personal, and it's happening internally. Let's look at the players. On one side, you have the Shapoorji Pallonji family, and they hold a very significant minority stake in Tata Sons. Then, on the other side, you have Noel Tata and the towering influence of the Tata Trusts, who basically control the vast majority of the company. These major shareholders have historically had very, very different motivations and stakes in how things are run. An IPO would completely upend the power dynamics. Think about it. For a minority shareholder, a public listing could unlock massive liquidity and establish a crystal-clear market value for their shares. But for the trusts, going public means giving up their incredibly tight grip on the empire. It means answering to public shareholders, facing those quarterly market pressures, and dealing with relentless external scrutiny. If they actually are forced to go through with this, we are looking at an IPO of unprecedented, truly massive scale. Tata Sons holds the keys to airlines, steel, software, automotive, consumer goods, I mean, the list goes on. Trying to value the holding company of that entire empire for public markets, that would be an absolute earthquake in the financial world. The sheer volume of capital involved here would instantly make it one of the most significant public offerings in market history.
No exaggeration.
Section 4. Impact on retail investors. So what does this actually mean for your portfolio? If you're following the markets, here is your actionable checklist. First up, you need to track the RBI's updated NBFC lists. The regulator updates these periodically, right? And if Tata Sons manages to somehow get their name off that upper layer list, well, the IPO threat vanishes instantly. Second, keep a really close watch on Tata's ongoing deregistration efforts. Every single time they sell shares in a subsidiary like TCS or restructure their debt, they're moving a chess piece to avoid listing. And third, you want to permanently circle that impending 2026 deadline on your calendar. As we get closer to April and June of that year, market volatility and speculation around Tata-linked stocks is absolutely going to surge. Ultimately, the outcome of this standoff remains deeply, deeply uncertain. We're watching a high-stakes collision between a 150-year-old tradition of absolute private control and a modern regulatory machine that demands public transparency for entities of this massive scale. Whether Tata Sons successfully dodges the regulation through, clever financial restructuring, or whether they're finally dragged, kicking and screaming, onto the public markets is still entirely unresolved. Which brings me to this final question for you. Should Tata Sons be forced to list? Does a company of this size and systemic importance owe the public transparency? Or should a private entity be allowed to remain private, regardless of how massive its scale is? I really want to know what you think about this, so definitely drop your thoughts in the comments below. And make sure you're subscribed to this Explainer series, because you can bet we will be doing a massive follow-up the second the RBI makes its final ruling. Until next time, keep learning and keep watching the board.